Bonds are a type of investment, often considered more conservative than stocks, that are issued by governments or corporations. When an investor purchases a bond, they are essentially lending money to the issuer for a set period of time in exchange for regular interest payments. At the end of the bond's term, the issuer repays the original investment, known as the principal. As an investor, understanding how to invest in bonds is important, as they are integral to a well-balanced investment portfolio. In this guide, I'll walk you through the basics of bonds, how to invest in them, and some of the factors to consider when adding them to your investment strategy. What are bonds and how do they work? Bonds are fixed income securities, meaning they provide a regular, fixed payment to investors. They are considered a type of loan, where the investor is the lender and the issuer is the borrower. When you invest in a bond, you're essentially lending money to the issuer for a specified period of time in exchange for periodic interest payments, known as coupon payments. When the bond reaches maturity, the issuer repays the bond's face value, also known as the principal. This return of principal makes bonds different from stocks, which typically do not have a defined maturity date. Types of bonds. There are several types of bonds, including government bonds, municipal bonds, and corporate bonds. Government bonds are issued by a country's government and are often considered low risk due to the backing of the government. Municipal bonds are issued by states, cities, or other local government entities to fund public projects. Corporate bonds are issued by companies to raise capital for various initiatives. Corporate bonds tend to offer higher yields than government bonds, but they also come with higher risk. Understanding the differences between these types of bonds is crucial when considering bond investments for your portfolio. How to invest in bonds. Investing in bonds can be done in several ways. You can either buy individual bonds, typically through a broker or an online platform, or invest in bond mutual funds or exchange-traded funds ETFs that hold a diversified portfolio of bonds. Each approach has its pros and cons, and the choice often comes down to individual preferences, risk tolerance, and investment goals. How do bond prices and yields work? Bond prices and yields have an inverse relationship, a concept that can be confusing for beginners. When interest rates rise, bond prices tend to fall. And when interest rates fall, bond prices tend to rise. This is because the market value of existing bonds is impacted by changes in interest rates. The yield of a bond is the return an investor receives from holding the bond, considering both its interest payments and any changes in the bond's market price. Yield is a crucial factor to consider when evaluating bonds, as it directly affects the income you can expect from your investment. Risks and considerations. While bonds are generally considered less risky than stocks, they are not without their own risks. Interest rate risk, credit risk, and inflation risk are just a few of the potential pitfalls associated with investing in bonds. It's essential to understand these risks and carefully evaluate the creditworthiness of the issuer before investing in bonds. Additionally, investors should also consider the impact of taxes on bond income and the potential role of bonds in a diversified investment strategy. Many investors use bonds as a way to balance the risk of their portfolios, providing stability and income even when stock markets are experiencing volatility. In conclusion, investing in bonds can offer a reliable source of income and a way to diversify your investment portfolio. By understanding the fundamentals of bonds, the different types available, and the risks involved, beginners can make informed investment decisions. Whether you choose to invest in individual bonds or bond funds, it's crucial to carefully consider your investment goals, risk tolerance, and the overall role of bonds in your investment strategy. With the right knowledge and a clear investment plan, bonds can be a valuable addition to your investment portfolio.